Nick Timmeros of the Wall Street Journal. Chair Powell, in your testimony 2 weeks ago, you had indicated you thought the terminal rate would be higher. Obviously, that was before the stress in the banking sector. And I realize there's a lot of uncertainty, but can you explain at all to what extent your forecasts or those of your colleagues or those of the board staff incorporated today a material tightening of credit availability because of the stress in the banking sector, or are you waiting to see it in the data before you incorporate that potential tightening into your forecasts?
So, we've just come from an FOMC meeting, and, the people who write the minutes will be very carefully counting. But I'll tell you what I heard. What I heard was a significant number of people saying that they anticipated there would be some tightening of credit conditions, and that would really have the same effects as our policies do, and that therefore they were including that in their assessment, and that if that turned out not to be the case, that in principle you'd need more rate hikes. So some people did reflect that in their SEP forecasts. I think there may also just have been, remember, this is 12 days ago. We're trying to assess something that just is so recent, and it's very difficult. There's so much uncertainty. So December was a good place to start, and we wound up with very similar outcomes for December. And in a way, the data in the first part, the first 5 weeks of the intermediate period, pointed to stronger inflation and a stronger labor market. So that pointed to higher rates, and then this latter part, kind of the possibility of credit conditions tightening, really offset that effectively.
To follow up, have you considered at all whether your primary tool, the funds rate, is going to be enough to sustain the kind of tighter financial conditions that you believe will be necessary without doing significant damage to the banking sector? Have you, for example, considered changing reserve requirements, selling assets out of the system open market account as a way to better achieve tighter financial conditions that don't accelerate deposit erosion, for example, from banks?
We know that we have other tools in effect, but no, we think our monetary policy tool works, and we think, many banks, our rate hikes were well telegraphed to the market, and many banks have managed to handle them.
Victoria. Hi, Victoria Guida with Politico. I wanted to ask, you, along with the FDIC and the Treasury, the Fed Board decided to invoke the systemic risk exception to allow uninsured depositors to be protected at these two banks. And I was just wondering if you could speak to why that decision was made. Was it purely a confidence issue, or was there a concern that there would be some sort of economic contagion or financial contagion from the failure of these banks?
The issue was really not about those specific banks, but about the risk of a contagion to other banks and to the financial markets more broadly. That was the issue.
Okay, and then can you also, just to follow up, can you speak to the role that you will be playing in the Fed's internal investigation on its supervision and regulation? So
Vice Chair Barr is, of course, leading that review, and he's responsible for it in his capacity as Vice Chair for Supervision. I realized, right away that there was going to be a need for a review. I mean, the question we were all asking ourselves over that first weekend was, how did this happen? And what we did was early Monday morning we sat down and said, let's do this, and he was obviously going to lead it in his capacity. So I don't, my role was to announce it, and I get briefed on it, but I'm not involved in the work of it.